Welcome to Michigan Reimagined, presented by Good Marketing and Wagoner Financial. And here's your host, Chris Buck.
So with the One Big Beautiful Bill signed into law recently, significant tax changes are on the horizon for both individuals and businesses. So what do you need to know? Well, listen into the experts as we hear from Costerisan's principal, Jen Danko, and Senior Manager Kevin Todd. Welcome to the show, Jen and Kevin.
Hi, thank you.
So for those not familiar, tell us about your firm as a company, Costerisan. What are the services that you provide for your clients?
Yeah, Maynard is a full-service CPA firm, and we also offer business advisory services. We're headquartered in Lansing, Michigan, and have a second office in Grand Rapids. We've been around for 100 years.
Wow.
Obviously, offer traditional tax audit services, but really so much more than that. So we do business valuations, consulting, technology. And then in 2020, we opened a wealth management branch of our firm. So a lot of services that we offer. We think we really give a holistic approach to clients, and that's really what brings a lot of our value to the clients we serve.
Got it. So with all of that on your plate, having a bill as significant as the OBBB, I guess we're calling it in the inner circles, passing kind of ratifies new rules and laws and changes and all of that stuff, right? So,
it does.
So your firm kind of owns the need to know what it all means and relay that to your clients,
You've
right?
got it. Yeah. So while most of us were enjoying cookouts and fireworks, Congress was creating a new spark, and they passed this. We're calling it OB3. That seems to roll off the tongue a little bit more than the OBBB bill. But yeah, there's a lot to that bill and a lot to unpack there. Obviously, we'll hit highlights today, but more definitely that we won't be able to touch on. So absolutely, for anyone who's got questions, feel free to reach out to us. We can unpack more of it than what we'll talk about here today.
Right. And it seems like as that process, they talk about the making of the sausage in politics, people these days tend to just land on their side of the pendulum and maybe didn't pay much attention to the nuance. So I think this is kind of a wake-up call show to whether you were a big fan of this administration or a big opponent of this administration. You still have an obligation as a citizen to know what the heck's going on.
Absolutely.
And then there's probably opportunities. You could either do something wrong or you could miss advantages of doing something right as you're going through your finances.
Yeah, so maybe let's unpack some of this.
Yeah,
so first things first, let's talk about the things that President Trump talked about on the campaign trail.
Okay.
How those worked their way into this bill, and maybe what we ended up getting. Maybe a little bit different than what he talked about in the campaign trail, but how did that come into law? So the first thing that we often hear about is clients talking about no tax on Social Security. That was a big thing that President Trump talked about on the campaign trail, that he would relieve those receiving Social Security benefits from that tax. Really, what we ended up getting is a $6,000 deduction for taxpayers over the age of 65.
Okay.
And so that's going to run from tax years 2025 to 2028. And so if you're married filing joint, you can get two $6,000 deductions, so a $12,000 deduction in total. So not exactly tax-free Social Security, but if you are of that age, and of course, like all things in the tax bill, there's restrictions. So there's income limits on who can get that. Phased out completely if you're single at $175,000. If you file married joint, it's $250,000. So if you're within those income limits and at that age, you get an additional benefit, but not exactly tax-free Social Security.
Got it. Okay.
Yep. Some of the other things that we mentioned on the campaign trail were no tax on overtime and tips.
Okay.
And so that also worked its way into this bill. Again, not exactly as it was phrased initially, but if you work hourly and you put in extra time for extra hours or you earn tips, this one's for you. So I usually think of like servers, bartenders, hairstylists. I'm sure there's a plethora of people this would apply to. But you could get up to a $25,000 deduction on your tip income from 25 to 28. So definitely something to keep an eye out for and ensure that it's worked into your tax return if that applies to you. Again, like all things, income restrictions.
Right.
But same would be true for overtime. I know on the overtime, a lot of people were really excited thinking all of my overtime pay is now tax exempt. This really only works for that time and a half. So it's that extra half that's tax deductible. So if we think of you make $40 an hour, time and a half is 60. That extra 20, that's what we're really targeting here, is that is potentially what you can exclude from income.
Got it. Okay.
So again, limits on that up to $25,000 married filing joint, $12,500 if you're single. Overall income limits apply to that as well. So a lot of things that we talked about on the campaign trail that worked its way into this bill, but not maybe exactly or blanket as covered on the campaign track. So
which isn't, I guess, terribly uncommon.
Right. Correct.
Because you do have the checks and balances and things get negotiated as they go through.
Sure.
So it's hard to tell the intent, but okay, but that's something. Right. And that's important to track. And there's a lot of people that are going to be affected by this.
Correct. And hopefully in positive ways. So a lot of what's baked into this bill is things that would help middle class. I know I work with a lot of more high-end individuals, and they're saying, I pay my fair share. Unfortunately, a lot of these benefits won't help them. Yep. They do get the benefit of we'll call it permanent tax rates. I say permanent with air quotes because they're only permanent until someone comes in and changes them.
Right. Okay.
And then the lifetime exemption is set at $15 million. So if you're super wealthy, there's some long-term savings there. And if you're looking for another friend, I'm available to give a gift to. But most of what's in this bill is meant to help the middle class.
Got it. Makes a lot of sense. So now, if I fall into one of those employment types and I'm listening to this show, I might be quickly taking notes and saying, now, what did she say and how much do I get? But what's the mechanics of all of that? I mean, how do you ensure that you're maximizing that? Obviously, the hope is that you've got a great tax professional that is going to do your returns. Is that a service that's kind of automatically
So we're still waiting to see how all of this information will even get tracked on a W-2 so that the taxpayer knows how much is even available to be able to be deducted. So time will tell what those forms happen to look like. We haven't seen anything yet. We've heard that there might be some delays on that information coming out. There might be some kind of free passes, if you will, for the first year of getting the reporting correct from the employer standpoint. But really, that's going to be our first drivers for those in payroll. What does this mean for you, and how does that reporting look? Right.
So we're recording this in August of 2025. So who knows when people are actually going to be hearing this in older iterations. But you as the tax service professionals need to have the data that you can trust in the W-2. And then you need to have the right sections of the fields of the legal forms that need to be filled out by clearly April 15th, right? So the goal is that this happens in the fall so that when you're off to the races in the new year, you have the tools you need.
Correct. And for a lot of these, there is upper ends on when you're phased out of these. And so you really want to make sure that your bracket management is key. So whether we're deferring income when you can, if you're a business owner, or accelerating deductions, some of these things have income phase outs. And so we want to make sure that if you're trying to get your biggest bang for your buck, let's make sure we are doing some forethought planning into what does the holistic year look like? How can we get the max benefit?
Right on. Okay. Makes a lot of sense. Any other big news that you want the individuals to know?
Yeah. Another really exciting thing that came out of this was for the first time, at least in my career, so in the last 14 years, taxpayers now have the ability to deduct auto loan interest. So that's never been a thing before. So this is for tax years 25 through 28. You can deduct up to $10,000 of auto loan interest on a new vehicle. So can't lease it, got to purchase it. And it has to be a U.S. assembled vehicle. So some stipulations there to keep it U.S. home based. And this is available whether you itemize or take the standard deduction. But like all things we've talked about, and I am sure you can see this one coming, there's income limits. So
Right. And as an auto guy and an economic developer who's really close to the automotive manufacturers in Michigan, that's a cobweb as to what is it's assembled.
I think it's final assembly.
Final assembly in
I imagine
the U.S.
Correct.
Okay.
And have not yet determined what that means, right? Can you put the final sticker on in the U.S. or does it have to be a major part of the vehicle? So if you're in the market for a vehicle, make sure, and you want this deduction, make sure you check that before signing the final paperwork.
Because everyone thinks of the big three, but Volkswagen and Honda and Toyota all have assembly plants somewhere around the United States, but they also have models that do and don't qualify. And then some of the big three also does the final assembly out of country in a couple of cases too. So
and I don't know if I mentioned, so it's up to $10,000 of interest that you can deduct each year.
Okay. Fascinating. Okay. That's neat to unpack.
Yeah. Let me see. There's some big ticket points. For a lot of our clients, they remember the days of COVID when you could take a charitable deduction but not itemize. So this was part of our 2020 legislation where you could give $300 to $600 to charity, still take advantage of those heightened standard deductions, but get a benefit for the goodness of your heart for what you give.
Yeah.
That piece of legislation is back in this OB3 bill. And so for taxpayers starting in 2026, if you're not in a position where you need to itemize, where it's more beneficial to take the standard, you can still get a deduction for your charity up to $1,000 for a single individual or $2,000 for a married filing joint individual. So great ways to still give and get that tax benefit that kind of goes along with it. But caveats, has to be cash. Can't be like the Goodwill clothes that you donate. It's got to be a cash donation.
Right. Okay. That makes a lot of sense. Hey, you're just spreading good cheer. I mean, there's all kinds of positive news.
Right.
For the...
As a taxpayer, you don't always get to give good news.
Right.
So when I can give it, I absolutely want to take advantage of that.
You'll pay less.
Correct.
Is really the message that you're delivering. Okay.
Yep. A few other things. From an energy credit standpoint, this administration has really put an end to a lot of those deductions. So if you are in the market for a new HVAC system or going to buy a clean vehicle, there's really some deadlines that you need to be aware of as a part of that. For vehicle credits, that can end as early as September 30th of 25. For energy efficient credits, so again, think those like solar panels, HVAC systems, that ends December 31st, 25. So if you're going to make some improvements to the house and you want to take advantage of those credits, have those dates in mind and maybe do those things sooner rather than later.
Makes a lot of sense. Okay, got it. Thank you. I didn't know that one. That's important.
Yeah, get those windows installed now. Like, don't wait
we've been
till
kicking
winter.
tires on the whole solar concept, but you do it for the right reasons, but there are tax implications if you do it sooner than later.
Correct.
So.
If you're going to do it anyways, we might as well get the tax benefit.
Right.
And so be aware of those deadlines and make sure you're within that window.
Fantastic. That's all great information, Jen. I appreciate that. But I want to give a nod to our friends at Good Marketing. Here at Michigan Reimagined, we tell stories of passionate Michiganders doing great things across the state. Today's podcast sponsor takes the art of positive storytelling to a whole new level. The good people at Good Marketing work with organizations across the state that are having a positive impact on the lives of Michigan residents. They help educate communities on the importance of affordable housing, the impact of wildlife and natural resource management, the availability of workforce development and education programs. If it lifts people up and makes communities stronger, then they want to help spread the word. If your organization needs help communicating the good work that you do, stop by their website at goodmarketing.com. That's GUD marketing.com. So Kevin, you've been quiet over there.
I have.
And you're the business guy, or at least you're sharing today
I'm one of them. Yes.
on the conversations as to how not only of individuals you need to stay in tune with the OB3, but how business owners, can benefit or at least pay attention to some of the changes that are out there. So
absolutely. And unlike the individual side, we don't have a whole lot that's brand new coming in.
Okay.
We have a lot of things that are coming back or some things that have been kind of changed in the big picture.
Got it.
So I'll just hit a handful of the big ones there. Research and development has been a big topic for several years. Under the Tax Cuts and Jobs Act that was passed in 2017, there was this little lingering provision that didn't take effect until 2020 and caught a lot of businesses kind of a little bit out of the blue. And that was a requirement that R&D expenses be capitalized. That is, they weren't currently deductible. They had to be put on the balance sheet. They had to be amortized over a period of time.
Okay.
So if you had $1 million worth of expenses, you got to take 10% of that in the first year, 20%, 20%, 20% in following years until you had used up that $1 million.
Okay.
For companies that specialize in R&D, computer software developers, things like that, that's a big hit. That was suddenly 90% of their deductions that had gone away. So there were a lot of tax balances that needed to be addressed in that case. So now with the OB3, starting with tax years in 2025, we are back to being able to expense those expenses or deduct those expenses normally on the current year tax return. There are also provisions in there for what are called small taxpayers, basically those with roughly 31 million of annual revenue, small, right?
Yeah, right.
Where they can actually go back and make an election and amend the 22, 23, 24 returns to go back to the previous treatment or the current treatment, depending on how you want to look at that. There are also opportunities for them. Maybe they don't want to go back and amend, or companies that are too big, they can't make that election. They can actually catch up. They can kind of clean out those capitalized assets based on the R&D expense, either in 25 or 25 and 26, depending on the circumstances.
God, let me ask a question as a naive citizen on the planet who is not in the tax world. Everything you're talking about is federal taxes, right?
Correct.
Yes.
So you're talking about R&D tax credits, basically. And I know that the state that has a lot of intellectual property and manufacturing and some software, certainly, but there was a big push to have our state tax code incorporate R&D tax credits. And I've lost track of whether that has happened under the Whitmer administration or if it's still being batted around, or I guess I don't want to unpack that box maybe if you're not prepared to answer it, but I guess the biggest thing is what we're talking about here is federal tax code.
Yes, absolutely.
And then this would not have anything to do with Michigan tax code because this is all federal driven.
Well, it can affect the state returns as well, because the state follows roughly federal taxable income. So if we are taking these deductions away at the federal level, they're also going away at the state level as well.
Right.
As far as the state level R&D credit, I have heard that I think it might be out there, but I don't have anything.
That's okay.
Today. I can say
we didn't
for sure
prepare for that, but it just dawned on me as we were talking this through that this is all federal level.
No, that is a great
let our
point.
listeners know.
Yep. Let's see. Depreciation. So we talked about breaking up those R&D expenses. If you buy equipment for your business, if you buy most assets for your business that are going to be in service for more than a year, you're required to depreciate them.
Yep.
So simple example, just like the R&D, you buy $1 million piece of equipment, you take a certain amount of that on tax years going forward. There is this concept out there of bonus depreciation. So this was something that Congress gave the business owners at some point back in the day. Don't remember the exact year that this kicked in, but it has fluctuated over the years. It is routinely 100%, sometimes 80%. It's been declining over the last few years under the Tax Cuts and Jobs Act. Now, OB3 has reset that permanently back to 100%.
Okay.
So here in 2025, it was previously at 40% under current law, which has now been updated to that 100%. Basically what that does is for certain assets, not all of them, it allows you to take that 100% of that depreciation deduction in the current year rather than breaking it up over time. Now, if you have an asset, under those previous rules that did not get fully depreciated, it was only at 60%, 40%, that is still something that is kind of hanging out there over time. You can't go back and catch up.
Okay.
There is an election out there that will allow you to take that 40% rate for 2025 as opposed to the 100% rate. And there can be reasons for doing so as you're looking at income shifting, taxable income, net operating losses, things like that, where you actually want to take that smaller deduction in the current year rather than take the bigger one. So, but that's on a case-by-case basis that you want to have that discussion. They also added in a new category of property called qualified production property. Now, this is a non-residential real property. So think a building used for manufacturing, production, refining, those specific areas. And what has to go on in that building or part of that building is what the code calls a substantial transformation of the product.
Okay.
So what this does is this allows that property now to be eligible for this 100% depreciation. So normally commercial property is subject to a 39-year life.
Okay.
So we have to take that deduction, spread it out over 39 years. But in this case, at least the portion of the building that's used for these processes would be deductible 100% in the year it's placed in service. Now, that's a big deduction.
Yeah, it is.
That is in place for property that's placed in service after July 4th of 2025.
Okay.
And ends out there, I believe it's around 2031. So, there's quite a window that's out there for everyone to take advantage of this. I'm sure there are going to be very specific regulations that come out as,
right.
The Treasury Department digests everything.
So the intent on that is to try to spur people with this incentive to act
Absolutely.
Because there's such a financial advantage to turning something on in the U.S., reshoring of manufacturing.
This is one of those things that definitely plays into the whole, tariff intent as well as reshoring American manufacturing.
Right on. Okay. So that's a heck of a benefit that the economic development community needs to know. And it's a federal thing, so it's kind of apples to apples. So whether a company decides to build in Colorado or Michigan, you're still competing on the same, you have to compete in other areas because that's not a benefit that's specific to a state.
Right.
But
some states, since you brought that up, actually do not recognize that bonus depreciation. So there can be varying state level impacts to this as well. So this is another reason why you definitely want to talk with a tax advisor, as you're contemplating these kinds of things, to make sure that you're getting the biggest bang for your buck and taking advantage of what's out there, both at the federal level and the state level.
Got it. Okay. Excellent. What else can business owners be excited about?
Well, another benefit that's out there is a reduction in business interest expense limitations. So again, under the Tax Cuts and Jobs Act, another one of those sneaky little provisions that didn't come into place until a couple of years ago. Deductions for business interest expense have been limited. Previously, they were roughly limited at 30% of EBIT, earnings before interest and taxes. Yep. And then in 2022, they were limited to EBITDA. So we're adding in depreciation and amortization to that calculation. So we took additional expenses that were part of that 30% calculation. So as you add more in, your limitation increases. You're only limited to a smaller amount. So if you are a business that has a lot of capital expenditures that you're depreciating, a business that deals a lot with acquisitions or other intellectual property where you have a lot of amortization of those assets, this was probably not a great thing for you, especially if you were highly leveraged. So now, under the OB3, they've backed out that depreciation and amortization add-in, which the expense is still limited to 30% of, again, roughly EBIT. There's a little bit more to that calculation. But that takes a big chunk out of that limitation for most businesses.
Okay. All good stuff to know. I mean, it's a moving target, right? So it's hard to keep track of all of this, which is, again, why we have professionals in the industry like you who can help people get their returns together and understand what they're qualified for.
Exactly. And a lot of these can be very big numbers.
Right.
Depending on the business. And, even if they're not very big numbers in the big picture, they can be very big numbers to an individual business.
Right. So,
it's important to, have that person that you're working on these things through and doing these kind of tax planning, tax strategy conversations, throughout the year, not just in January where you come in and say, hey, I spent $4 million on a building and, to find out that it doesn't qualify for some provision or another. Right.
Right. Now, with that said, and this is just me wondering, you don't need to have an answer to this, but you talk about a lot of these sunsetting almost pretty much at the end of the administration, right?
Correct.
So it seems like businesses and individuals can make some longer term decisions based on today's tax code. But I would imagine, you've been in the industry long enough that the pendulum shifts, right? So these things expire, new things replace them. And so it seems like a pretty consistent moving target. Do you have clients that ask for counsel on, here's a decision I'm going to make that's going to last 25 years, but part of my decision making is 4 years worth of federal tax code that I know of? Can you give me any counsel as to your opinion? I know you obviously don't have a crystal ball, but am I making a bad long-term decision because of some cool short-term stuff that's likely to go away? Or,
right.
I mean, that's got to be a complex part of your job that you must be asked tough questions that you probably can't answer very cleanly.
Well, I think that's exactly right. I think we can answer them cleanly. And I know Jen deals with this on the estate and, kind of estate planning side as well, is we have to work with what we know.
Right.
We knew at the end of last year that something was going to happen. The Tax Cuts and Jobs Act, most of that was expiring on the individual side. So we had to say, okay, when this expires, this is what's going to happen. We know something's going to change, but we don't know what. So, with the OB3 coming here in July, now we can firm up a lot of things that were question marks last fall.
Right. We're just very thankful that this got passed in July, because the previous tax change, the Tax Cuts and Jobs Act that Kevin's referring to, I think that passed on December 29th of that year. And so this at least gives us 5 good months to plan. And a lot of these things don't go into effect until 2026. So now we've got at least the end of this year and can, plan the whole following year for how to best maximize deductions or how to minimize income. But you're right, we can only plan for the known, and we only know what's going to happen in the next 4 years.
Right. Yeah. And then some of this is out of your hands, right? I mean, you and probably a team of experts will read the bill.
Thousands of pages of bill.
Right.
Yes.
And make high level, these are the types of things we can expect. But you're also waiting for the feds to give you a real deliverable, like this is the tool you're going to use, or these are the exclusions, or this is the small print,
exactly,
and the forms that you need to use, and that all can change.
Well, and I think a lot of the times
efforts.
They put out this legislation, but they don't think of the practicality of it
right.
or how it plays out. And so that's the piece that we're really waiting for now is you've put all this into law. What does that mean? How did you expect that to play out? And sometimes we find that there was wording differences of what legislation thought they were saying and what they actually said. And then there becomes this backtracking of how do we go back and correct? And that could take years.
Can I just express my gratitude that you are in the roles that you're in and that you're built to do that? Because boy, I would be awful at that role.
We hear that a lot.
That's why we pay for your services. And another person we pay services to are our insurance agents. I'd like to let everyone know that today's podcast is sponsored by our good friends at the Kirk Byron State Farm Agency. Their mission is to put the customer first when helping them plan for the risks of everyday life, to prepare for the unexpected, and to realize their financial goals. Kirk and his team build value and confidence in your auto, home, life, health, business insurance, and financial service needs. Kirk is always looking for opportunities to help customers in mid-Michigan and around the country. Everyone has insurance needs, and you do well by contacting Kirk Byron State Farm Agency and hear what these experts have to say. You can get in touch with them by calling them at 517-349-3830 or look them up at sfbyrons.com. You won't regret it. So is there any more? I'm sure that there's all kinds of pages of things.
There's tons more.
Right.
We could fill all day.
But higher level, those are all nice, juicy bits of information. Those are the really
biggest things on the business side.
Right.
Like Jen mentioned, we do have the expiring energy credits as well on the business side. Those aren't necessarily as common for smaller businesses, like we'd find in the Lansing area. There are some nuclear plant credits and things that are expiring, which we don't generally have to worry about.
Right.
But I think those are the biggest picture things on the business side. There is a limitation on charitable contributions now from a business perspective, also on the individual side. They've tweaked that a little bit. There's a lot of other smaller things. I know your listeners can't see it, but I've got a page in front of me here on the desk with an effective dates implementation.
Okay.
And it's just a page of, things that we can go back and amend. It's got things that take effect at the beginning of 25, the middle of 25, September 25, 26, other things that take effect out in 27, 2032 even. So there's a lot to this. And, going back to your comment about planning, having something like this allows us to take a look at when things are expiring. And we can also, hopefully make some better decisions based on, relying on the current law.
Now, is that document something that you've put together, or is that discoverable by our listeners? Is there a website they can go to, or?
This one was actually put together by the AICPA. I'm not sure if it's publicly available, but a quick Google search will tell you a lot of this stuff.
Got it. Okay. But if I'm listening and I'm trying to jot down some of these numbers and say, oh, that applies to me, other than rewinding this and hearing it again, what's your advice on the listeners to say, holy moly, there's a lot of new stuff.
Well,
how do I
call
begin?
Us, obviously.
Right, exactly. Well, how do they do that? Let's do the shameless plug now.
So anyone who's interested can get in touch with us by going to our website, ManerCPA.com, MANERCPA.com, or give us a call at the office, 517-323-7500. Other than that, make sure if you are working with a tax professional who's not us,
I don't know why you would, but
I don't know why you would. Ask them lots of questions. Make sure they're keeping up on this.
Right.
One of the things we saw this month was there were a lot of bad takes out there as far as what was being put out on websites, what was being put out in social media, like in different tax groups that were based on previous versions of the bill, not the bill that had actually passed and been signed.
Oh, okay.
So whoever you're working with, you want to make sure that they are up to date and, you're asking all of the questions that you want to ask. And if they don't want your questions, we do.
No, makes a ton of sense. I appreciate you being willing to come on board and talk about all this. I mean, like you said, it's all legislation that has been passed in the last 30 days.
Yep.
And you're clearly leaning into this is real. We got to prepare. And even though you're waiting for information from the feds for the details, you need a running start to know what the heck you're even dealing with. So
Absolutely.
I appreciate that. And I was also made aware that you've had, and I'm not sure if they're recorded or if they're live events, but you've been hosting kind of mini seminars to have these kinds of discussions, probably with more Q&A from audiences. How do people learn about your schedule for those kinds of things?
Yep. So at this point, we've had webinars for both the businesses and individuals. And so if they're interested in receiving the audio copy of that or the slide deck or anything that would go with that presentation, absolutely reach out to those resources like Kevin mentioned, and we'll make sure that that gets into your hands for your viewing pleasure.
Awesome. And that's ManorCPA.com.
You've got it.
Wonderful. Okay. What else? What have I missed? Is there anything else? I mean, obviously there's a lot of moving parts to this and we'll never be done the conversation, but in the interest of time, just want to make sure that there's nothing else that's got a big point on it that you want to get across.
No, I would say the biggest point is planning is key. We were given 5 months before the end of the year with the passing of this bill. And so take advantage of that. Use that time to figure out what portions of this bill affect you and use that time to plan to make sure that you get the biggest benefit from that passage of the law.
Makes a ton of sense. Thank you for sharing what you know at this point. Really, really happy to have you on board. We've been speaking with Principal Jen Danko from Manor Costerisan and your Senior Manager Kevin Todd, also from Manor. Really appreciate everything you do. ManorCPA.com. Check it out. They have all the information that's available to them for you to go view. I really appreciate you joining me here. Thanks for your time.
Chris.
Yeah, thank you.
And I'd like to give a final shout out to all my loyal sponsors. That's Wagoner Financial, Good Marketing, Triterra Environmental, Keller Williams Advantage and Team, Michigan Rise, Kirk Byron State Farm, and the attorneys at Foster Swift. All great people worth the call. And if you found this as a one-off, I remind you to follow and subscribe to Michigan Reimagined on YouTube, Facebook, Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, pretty much anywhere you find your podcasts. This is Chris Buck signing off for Michigan Reimagined.